In this video, we're going to talk about IFRS 18, presentation and disclosure in financial statements. IFRS 18 was issued in 2024 and replaces IAS 1. So its effective date is 1st of January 2027 and early application is permitted. It's applied retrospectively. It means that comparative periods should be restated. All right, IFRS 18 sets requirements for presentation and disclosure of financial statements. So we can see in IFRS 18 these ones: general requirements for financial statements, aggregation and disaggregation rules, statement of P&L, statement presenting comprehensive income, statement of financial position, statement of change in equity, notes, and appendices. So let's start with the primary objective or primary financial statements. So one of the objectives is to obtain an understandable overview about the company and then make comparisons between entities. So when we apply this standards and prepare financial statements, then it should allow us to make comparisons between entities. And also, we obtain additional information in the notes about the entity and its operations. Okay, we know that we have statements of financial performance, which includes statement of P&L and other comprehensive income, statement of financial position, statement of change in equity, statement of cash flows, and notes that include accounting policies. So these all reports are prepared for the reporting period. And this one, statement of financial position, is prepared as at the end of reporting period. All right, now let's look at the general requirements, identification and period. So in the financial statements, we need to clearly label the title and include the name of the company, currency, date, and precision, which means whether the numbers are in thousands or millions. And usually financial statements are prepared for 12 months, but if the period doesn't equal 12 months, then we need to disclose the reason and note comparability. Here is the ABC Group statement of profit or loss for the year ended 2002. So you can see the minimum required items presented here, and then comparative period results. And the precision here in thousands, company name, ABC Group, the label of financial statement, statement of profit or loss, and the period for the year ended 2002. All right, now let's talk about consistency and presentation. We need to keep the presentation and classification of items in the financial statements consistently, unless new IFRS requirements tell us to do differently, or we know that alternative is more appropriate. So if we applied alternative methods rather than consistently following those rules, we can also do it. And we need to think about materiality. In this case, material means that influences users' decision. So if they are material items, we need to show in our financial statements. Comparative info. Minimum 1 year comparatives, such as numerical or narrative, should be included. Narratives we include when relevant to understanding the current period's financial statements. For example, legal disputes, right? But also we can include them for the comparatives. Then if classification and presentation amended, what we do? If it's practicable, then we state the nature, amount, and reason in our disclosures and do it. If it's impracticable, then we should stay in the disclosures the reason why we cannot do it and why it is impracticable. Practicable is widely used in financial reporting and auditing. It means that something can be put into practice. It is not the same as practical. It may not be practical to do something, but it is practicable if it can be done. All right. Now let's look at the accounting policy change and prior period error corrections. So if it happens, then what we should do? We should restate prior period, and also we need to show the third statement of financial position for the beginning of prior periods as a comparative. So this is the rule, please remember about this. Now we're going to look at aggregation and disaggregation. So we have principles related to aggregation and disaggregation and offsetting. So we need to aggregate our items based on characteristics shared, and we should fulfill the roles of financial statements, which are faithful presentation, understandability, and relevance. Then also we should not obscure material information. It means that material info should be stated clearly without irrelevant data in our financial statements. And these are the items that may require disaggregation. In the statement of profit or loss, we can see write-downs of inventories, impairment losses of PP&E, income or expenses relating to restructuring, income or expenses relating to disposals of PP&E, income or expenses from litigation settlements, non-recurring income and expenses. And in the statement of financial position, we can see PP&E, IAS 16 classes, receivables, whether they are trade or prepayments, inventories, provisions, equity, capital, and reserves. Now let's look at the offsetting. Offsetting is usually not permitted by IFRS, so assets and liabilities and income and expenses should not be offset unless IFRS requires or allows to do so. So in which cases IFRS requires and allows. Tax assets and tax liabilities, legally enforceable rights, they can be offset. Exchange gains and losses, they are presented in net amount. So if you have exchange gains or exchange losses, or both of them, then you should show the net amount in your financial statements. Bank overdraft versus cash, overdraft repayable on demand if you have them, so you can offset them against cash. All right, now the current and non-current distinction. So we have to show our assets and liabilities based on non-current and current distinction. So current assets and non-current assets, current liabilities and non-current liabilities, unless liquidity order is more useful. So if you think that liquidity order is more useful, then you can also use this one. All right, in current assets and liabilities, we need to include those ones with operating cycle which are less than 12 months, which are for trading purposes, cash equivalents, and the rest should be included in non-current assets and liabilities, which are not stated here. Here is the statement of financial position. As you see here, assets are divided into non-current assets, then you have totals of non-current assets, then you show separately current assets and their totals. And what about the liabilities, equity and liabilities? So in liabilities, you have equity attributable to owners of the parent and also non-controlling interest. Then you see that liabilities are divided into two categories: non-current liabilities, their totals, and current liabilities and their totals. Then you see total liabilities and total equity and liabilities. According to IFRS 18, new rules are introduced to the categories in the statement of profit or loss. So now all income and expenses should be categorized into different categories and statement of profit or loss. So let's look at them: operating, investing, financing, income tax, and discontinued operations. So first of all, we need to understand if there is a specified main activity of the business in order to understand into which category, operating, investing, or financing, we should classify our income and expenses. So if the company invests in assets or within the main activity or provides financing, so these are two different main activities, right? So we need to classify income and expenses in operating rather than investing or financing. So let's say, for example, interest expenses. It's in financing for production company, but for banks in operating category. Neither of these variations are examinable in financial reporting, and you should apply the general classification requirements in the exam. So these two different main activities, specified main activities, and classification in such way will not be examined in financial reporting exam. So we categorize income and expenses based on their nature, right? Investing, financing, income taxes, and continued operations. But if they are not categorized in all of these four, then by default, we categorize them into operating. So usually we have in operating income and expenses from normal trading activities, cost of goods sold, salaries, G&A expenses, selling, depreciation, impairment, loss on disposal. And in investing, we have income and expenses associated with investment. So the investing category includes certain items of income and expenses associated with investments held by an entity, such as like cash and cash equivalents, so investment in associate, joint venture, unconsolidated subs, and also interest income from cash and cash equivalents, financial asset interest income, dividend income, investment property rental income, and also investment property gain and losses on remeasurement of investment property measured using the fair value model, and gains on disposal, losses on the disposal of investment property. But also we should bear in mind that other expenses associated with the assets listed above, such as repairs and maintenance expenses associated with investment property, are classified within the operating category. So they are not related to the income generated or expenses used by entity for investment. So that's why they should be categorized under operating expenses. Also, there is an exception that entities with the main business activity is being investing in assets, as we saw in the previous slide. They should be categorized in operating expenses. Now let's look at financing. So income and expenses related to liabilities should be classified under financing category. So we have two types of liabilities, liabilities from raising finance and other liabilities. So the liabilities from raising finance are such as loans and bonds, and if we have them, we have income and expenses from initial and subsequent measurement, and also incremental expenses like transaction costs. So these should be categorized under financing. And what about other liabilities? Other liabilities such as employee benefits and provisions. If they are separately identified, then interest and expense of them should be classified in financing, and also change the interest rate should be classified under financing. Okay, so the next is income taxes. All income taxes, tax amounts should be classified under income taxes, and income expenses associated with discontinued operations should be classified under discontinued operations category. Now let's look at the totals and subtotals required by IFRS 18 related to statement of profit or loss. So as you see here, we have this minimum required items stated here, then subtotal of operating profit, and then profit before financing and income tax. As you see here, we don't have subtotals after each category. We just have here after operating category, the subtotal operating profit. And then we include those income and expenses related to investing category and have this profit before financing and income taxes. This is the subtotal, but after financing and income tax categories, we don't have here subtotals, right? So we have only here profit. And then minimum required like items are, as you see here, operating profit before tax and profit. And now minimum disclosure in statement of profit or loss. So these are the items that minimum should be shown in your statement of profit or loss: revenues, other operating expenses, then share of profit and gains on disposal of associates, and income tax expenses, profit from continuing operations we have after this, right? And then we have separately loss from discontinued operations. So this is the net amount of income and expenses related to discontinued operations. In our case, it's loss. And additional disclosures that may be required: interest revenue calculated using the effective interest method, impairment losses, gains and losses from the recognition of financial assets at amortized cost. So these are the additional disclosures. Operating expenses we can state by nature or by function. By nature, we aggregate our expenses according to the nature of economic resources used. For example, depreciation, amortization, raw materials consumed, employee benefit expenses. And we categorize them by function according to the activity to which they relate. For example, cost of sales, selling expenses, general and administrative expenses, etc. Entities that classify expenses by function must disclose additional information on the nature of expenses, including depreciation, amortization, and staff cost. So in the financial reporting exam, you may be asked to classify operating expenses either by nature or by function. This will be made clear in the question. And you may also be required to disaggregate and present separately material non-recurring items, such as an impairment loss. All right, now let's look at the statements of financial performance. They include statement of P&L and other comprehensive income. So we have two approaches. One of them is single statement approach, another is two-statement approach. In single statement approach, we have in one statement combined statement of P&L and statement of other comprehensive income. So we state our income and expenses, then the result, profit or loss, and then right after profit or loss, we state other comprehensive income, then the total of other comprehensive income and total comprehensive income. If we use two-statement approach, then we separately show statement of profit or loss. So we have as a result profit or loss, and then separate statement of other comprehensive income. Here we started with profit or loss and then state other comprehensive income and show total comprehensive income. So whichever approach is used by company, they should just follow these rules. So any company is allowed to use any of this approach, whichever they think is it gives a better presentation. So now let's look at the composition of total comprehensive income. So it has profit or loss from P&L statement and then other comprehensive income. So other comprehensive income can be should be divided into two categories: reclassified to profit or loss and not reclassified to profit or loss. So those ones reclassified to profit or loss are not examinable in financial reporting exam, and not reclassified to profit or loss are examinable. And also other comprehensive income we can show in different two approaches, net of tax effect or before tax effect. So if we add profit or loss and other comprehensive income, we have total comprehensive income. Also, we should divide it into two categories, those ones attributable to non-controlling interest and those attributable to the owners of the parents. So let's look at the example of total comprehensive income or the comprehensive income statement. So we started with profit, then we state here the items that will not be reclassified to profit or loss, and then we here state income and expenses that will be reclassified to profit or loss when specific conditions are met. And here we have other comprehensive income net of tax. So this is the presentation of that type of statement of other comprehensive income. And another presentation is where we have other comprehensive income before tax approach. So as you see here, again, items will not be reclassified to profit or loss. We state them separately, but after that, income tax relating to these items we state separately. Then we show items which will be reclassified to profit or loss, and then income tax related to those items are also presented separately, and other comprehensive income for the year, then total comprehensive income. Okay, now let's move on to the statement of changes in equity. So in the statement of changes in equity, we should show the reconciliation between opening and closing of P&L, OCI, and transaction with owners such as contributions and distributions. So together, P&L and OCI are also called total comprehensive income, and this total comprehensive income we should show separately for NCI and other owners of the parent. And in the statement of changes in equity also, we need to show the effects of the retrospective application restatements for each component of equity. Okay, now let's look at the example of statement of changes in equity. So as you see here, we have those ones attributable to owners of the parent and the non-controlling interest stated separately. And we start with a balance at 1st of January. So this is the opening balance. And if we had some change in accounting policy or other kind of restatements such as errors, we show here first and adjust the balance for the beginning. And then we show the change in equity for the period, such as issue of shares, dividend, transfers, let's say profit or loss, other comprehensive income that were transferred to the retained earning rate, and total comprehensive income and balance as at the end of the period. All right. Now, reclassification and transfers. So we need to reclassify the items only if allowed by IFRS. For example, fair value throughout the comprehensive income debt instruments not reclassified. The revaluation surplus is reclassified to retained earnings. So here we're gonna have this kind of journal entry, debit revaluation reserve or surplus to retained earnings. So we are reclassifying revaluation of PP&E, let's say, to retained earnings. Now let's look at the note structures required by IFRS 18. So we need to have basis of preparation, accounting policies in our notes, then information required by IFRS, which are not presented in primary financial statements. So all subtotals and additional information required as disclosures in line with standards like IFRS 16 leases or IFRS 9 financial instruments. Then other important information not presented in primary financial statements, for example, some events that may have affected the business. Then general information about the entity if not shown elsewhere. description of activity, legal name, who the parent is, etc. Management defined performance measures, numbers outside IFRS reporting, which are used by the entity to communicate its performance. We should present what they are and their reconciliation with financial statements. For example, free cash flows. This is a new one, and also it's not examinable by financial reporting. So we are not going to study this one. Then we have capital related notes. So capital-related notes, an entity should disclose in the notes information that allows users of the financial statements to evaluate the entity's objectives, policies, and processes for managing capital. And there may be other disclosures. An entity should also disclose information about each class of share capital, including number of shares that are authorized, issued, and fully paid, as well as reconciliation between the numbers of shares at the start and end of the period. Okay, now let's look at the exam tips for financial reporting. So you need to know differences between P&L and other comprehensive income, first of all. Then you need to know how to classify the operating expenses by function and nature of expenses. And also no extraordinary items allowed. Statement of change in equity, you should show the differences and changed clearly. Show the dividend and changed clearly. So please remember that dividends should not go through P&L. They always go through statement of change in equity as part of contribution to shareholders and decrease in retained earnings. All right, this was all about IFRS 18 for financial reporting exam purposes. Thank you for your attention and see you in my next videos.